Hello everyone. Today we are talking with Sahil Kapoor, who's the head of products at DSP Mutual Fund. He's here to chat about their new BFSI fund. Hi Sahil, how are you?
Hi, thank you. Thanks for having me here. I'm doing well.
Great. So we are very happy to have you with us today, Sahil. To begin with, there is a lot of talks going on in the BFSI sector that there is an underrepresentation of the BFSI sector so far. So do you have any words to start off with for that?
Sure. So I think the biggest differentiator for BFSI, of course, has been its very strong profitability, right? So over the last 20, 30 years, or whatever data you pick up, you will see that this sector, and particularly the lenders, they have compounded profits at a faster rate than any other sector in India. And also their profit pool is very, very large.
Right.
So if you look at BSE 500 companies, the total profit is about 11 lakh crores. Out of that, 4 lakh crores comes only from BFSI. And when you talk about lenders, it is 3.5 lakh crores comes only from lenders. So on an aggregate basis, this sector has about close to 38 to 40% share of profits. But when it comes to the market cap share, it ranges from 20 to 26% based on what type of market cap you're talking about. So in large cap, it's a little higher. In mid and small cap, it is quite low. So from a profit share perspective, I think the sector is under-owned or underrepresented. And even from the perspective of ownership, if you compare mid and small cap, there are very little, share that this sector has. Most of the lenders are either mid and large cap. So there are very few lenders in that space. And secondly, non-lenders, which is insurance, AMCs, etc., they are present in mid and small cap space. But of course, they are not owned as much as the lenders because profitability, profit pools are high there. So I think there is a lot of opportunity across the segment. And yes, as you said, there is a case to be made that this sector is under-owned and underrepresented.
So since you mentioned about other sectors like not only banking, other sectors like insurance and all. So this
Yeah,
BFSI sector, the BFSI world has changed a lot in the recent
yeah.
past. Earlier, it used to be just about banks and insurance. These two sectors were the largest. But now we have also got AMCs, mutual funds, fintechs, and a lot of lenders have come in. Can you tell
Right.
us more about this change and what do you think will make this diverse BFSI sector grow further?
Sure. So when you look at, let's look at the history, right? So first, let's look at the universe. So what we are talking about within the BFSI is banks, NBFCs, which also include housing finance companies. Then you have life insurance and non-life insurance. And then you have businesses based on capital markets like AMCs, exchanges, depositories. And then you also have the fintech universe, right? So this is the broad, sector sweep of what all is included. Now let's go back in time and see the data. If you look at banks and NBFCs and break it up between, let's say, the private sector banks over the last 15, 20 years have compounded profits at between 15 to 18%, whichever phase you talk about. Public sector banks, on the other hand, have compounded profits at less than 10, 11%, right? If you remove one or two large PSU banks, the profit is very small. The compounding is very small. So largely it's been about efficiency in that sector for the lenders. But as you move along the curve, when you talk about the other sectors, so look at life insurance, the overall sector. Last 10 years, where this universe has become more represented in the listed space, the PAT growth, the CAGR is 24%, right? Non-life is still loss-making at an aggregate level because companies are now maturing and we don't have all the listed universe, but the numbers are very similar there for mature businesses, right? So you can see that the profitability is growing at a faster rate in insurance. AMCs, again, the CAGR for the last 10 years has been between 20 to 22%. For exchanges, it is about 20, 21%. For depositories, again, in the vicinity of 21% or so. So, two very important points. Outside of lenders, there are these smaller sectors and themes which are growing profits at a faster rate than lenders. And lenders have been in focus right now. And as you asked, I think the complexion is slowly changing. Many other businesses are getting, listed, they're getting available, and their profit growth and ROEs are much more superior than just lenders. So I think this opportunity is possibly what is going to, be captured in the future as we move ahead.
Right. But having said that, historically, the BFSI sector has done pretty well. So, since 2004,
Yeah,
the Nifty Financial Services TRI has given what 17.61 CAGR. But recently, in the
absolutely.
last 4 to 5 years, the BFSI sector had a bit of tough time.
Yeah.
So, what are your thoughts on the chances of things getting better in this particular sector?
See, roughly, Sudhir, my idea is that I like tough times. I think they give you a better opportunity, largely because when things are euphoric or you have very high historical recent returns, usually the forward returns are lower. So I think in your own question there is a hint, of what to expect, which is that because the last few years have not been so good for this sector, there is a possibility that it could turn out to be a better bet for the future. And why do I say that? Let's look at three things. One, the price performance. As you said, if you look at the last 4 year rolling, performance of Nifty Financial Services TRI versus Nifty, you will find that it is underperforming by more than 5%. And the last time we saw such underperformance was back in 2009 after the global financial crisis. So we don't have the price froth. Second is look at the fundamentals. Banks have one of the cleanest balance sheets that we've seen over the last 20 years. The net NPA ratio are touching lows that we saw prior to the year 2000. Credit growth is, strong at 15% plus for the aggregate book. Third, there is demand for credit, right? And it is increasing as we go ahead. So not only the price froth is absent, fundamentals are also very, very robust for the sector. And the third and the most important aspect is the valuation. When you look at the overall index, it is trading below its long-term or very close to the average valuations that we've seen over the last 15 to 20 years. And it's very, very hard to capture low valuations or cheap valuations because they happen only when there is a crisis. And we don't have the expertise to predict a crisis. And therefore, if you have average valuations and no price froth, excellent fundamentals, I don't think there is any reason for us to not go overweight on this sector. And therefore, I think it's a great bet for the next few years.
So, the timing just seems to be about right to launch this particular fund.
Absolutely. It does appear that the timing is right. And it's also a hard call to make, right? When you don't have the recent returns, uh, many investors don't feel comfortable. So when you look at today, the investing world, a lot of people will be happy investing in the magnificent seven of the world, right? They've been giving returns for the last 15 years and also for the last 2 years. Fundamentals are great. In case of banking, I think something specific has happened. In each of these subsegments, either the top or the top two players have not delivered great returns over the last 2, 3 years. So many large companies which used to be market favorites and people wanted to buy them are available at cheap valuations today with their fundamentals intact, but the sentiment is different, right? And therefore, we think this is the right time where you can create a good portfolio of these quality companies.
Correct. And do you think there is any role of so since we as a country, we are aiming to reach $5 trillion economy soon, how
Yeah.
does BFSI sector fit into this plan and what kind of role will BFSI sector play of India reaching that particular goal?
So, Sudhir, largely all the sub segments that we discussed, banks, non-banks, capital market businesses and insurance, all of them have in India beaten our nominal GDP growth rate. So if you look at the last 15 years, our nominal GDP has grown at about 12% CAGR. All these sectors have grown at a faster rate. So when you take a look at, for example, banks credit growth, those numbers have grown at 15% or so, right? Each sub-segment has grown at a faster rate, and they have also grown their profitability at a faster rate versus the economy and versus the broader market also. So the point is that this sector is one of the best plays on India's story, right? And the reason is that it compounds at a faster rate. And there are two reasons for it. First is the penetration. In each of these verticals, India is underpenetrated, right? Whether it is banking, access to credit, access to insurance. In all these numbers, we are underpenetrated and we are moving in the right direction. These numbers are improving. More households, more individuals are adopting these services. Second, in India, many financial services, particularly the banks, are a well-regulated sectors. It's not possible to come and open a bank in India. It requires, RBI licensing, etc. It's a very, very tough job, right? So there is a sort of entry barrier that is created. And for many other businesses, the entry barrier is created because of the size and scale, right? And third point is that there is a use case to be made, that if the economic growth continues, it has to be supported by more credit. So we should remember that India is one of the least indebted nations. Whether it is our sovereign debt or corporate debt or household debt, we are much lower than all the countries, all the 40 other major economies that we have. For instance, India's household credit is just about 40% of GDP, which is much lower, right? And in many advanced countries, these numbers are over 100%. So I'm not saying we are going to go over 100, but all I'm saying there is room to grow, right? And therefore, I think it of course can play a very important part in India's growth. But more than looking at only the top-down number, let's remember that at whatever rate India grows, this can outperform the aggregate growth numbers and therefore give you better experience as an investor.
Amazing. And moving on from India, are we also planning to diversify and invest in international equities in this space?
So, Sudhir, I won't say that is one of our USPs per se, but we have an enabler. What we are looking at is not creating a diversified exposure because we have a funnel to buy global stocks. What we are looking at is to create global exposure when there is ample opportunity in terms of valuation and the kind of businesses we want to buy. For example, a case in point is, let's say, Berkshire Hathaway, a well-known Warren Buffett company, right? And there has been a number of crises in the past. If we have a COVID-like crisis or a crash, some of these stocks, not just let's say BRK, many other businesses globally, high quality businesses, not represented in India, they become available at very cheap valuations, and we want to take that opportunity, create a pure bottoms up, exposure to some of these great businesses globally. But it is always going to be a small allocation. It's not going to be a very large allocation and driven bottoms up. So the idea is to give that enabler to the portfolio to participate in some of these great businesses which are not available in India.
Great. And finally, let's talk about the mix. In the BFSI fund, how much will be invested in large, mid, and small cap companies? How do you plan to balance things out?
So largely, I think it's a function of what kind of business we want to buy. And as I said, when you look at the lenders, many of them are large cap and some are mid cap. So the exposure automatically goes there, right? Very few small cap companies will qualify as great portfolio additions of large quantity from this bucket. But what we are looking at is a very, very flexible approach in terms of allocating to subsectors. So traditionally, what has happened is that if you run a BFSI exposure of 100 rupees, roughly, people invest 65 to 85 rupees only in lenders, right? So you end up owning 3 to 4 top banks and maybe 1 or 2 NBFCs, and that's about it. That is the overall
Right.
portfolio. What we are looking at is investing between 45 to 50% in banks for this beginning, about 25-30% in NBFCs, and rest in the other capital markets, insurance, and other businesses. So we are going to give you a very elaborate, wide-ranging experience where other, non-lending businesses are represented, and our belief is that over time their share can go up. So this is the lens that we are looking at in terms of portfolio construction, rather than a mid and small or large cap lens. I think industry sub-specific sector is a better lens to look at in this space.
So this seems to be a very well diversified funds across all sectors.
Absolutely.
Great.
Within the BFSI theme, all the subsectors, I think
Subsectors, right.
it will have all the diversification required.
Amazing. Good to know that. Thanks for being with us, Sahil. I really enjoyed the conversation and looking forward to do a few more videos with you and your team at DSP.
Absolutely. My pleasure. Thank you very much.
Thanks, Sahil.
Thank you.